Joining us now on set is Robert Mead, Head of Australian Portfolio Management at PIMCO, and Jim Stening, Group Managing Director at FIIG Securities. Gentlemen, thank you very much for joining us today. Rob, tell us first of all, what did you think of the CPI data and what does it mean when the RBA sits down to deliberate on rates next week?
Sure, I think it was largely in line with expectations, a little bit higher on a couple of measures, but I don't think it changes the RBA's stance at all. They've been very clear that they're going to remove some of this emergency rate setting gradually, but they've used the word prompt, but they've also used the word measured. So I think that sort of a series of 25 basis points, at least for the near term, remains intact, and I think they get to sort of low 425s by low 4s and 425, maybe even 450 by early next year. And then it becomes a much more data-dependent exercise thereafter. Yeah, absolutely. Jim, did you see anything today that warrants 50 basis points next week?
Yeah, well, I mean, I think I wouldn't be surprised if that did happen. I think that obviously the return to or the removal of the emergency settings is an imperative. A return to a neutral setting involves a series of tightenings that you know, if you take the view that the inflation rate will average around 2.5, so we see the headline rate and the underlying rate converge over time, then we're talking about cash levels of 5.5 to 6%. So, you know, that will probably take 11 to 12 months to implement. So if you build in the fact that the Reserve Bank has a holiday in January, you know, that's a very slow way to return to neutral policy. But Rob's right. I mean, there's one thing that's different. It's different neutral and the removal of emergency settings. Right. You know, I agree it will be gradual, but I don't think you can rule it out. I really do think that you know, if they do a 50-point tightening either in November or December, it just puts them ahead of the curve a little bit.
And there are a couple of different things now, aren't there, from the last hiking cycle, and that is the Australian dollar is so strong now, indeed very close to parity. So to what extent does the strength of the Australian dollar also tame those inflationary pressures to the point where the RBA doesn't need to act perhaps as aggressively as otherwise? What do you think, Rob?
I think at the margin it's an influence, but if you go back to early 2008, when we had policy rates at 7.25, we also had the Aussie dollar up at 98 cents. So I don't think it rules out by any means the removal of the emergency setting, but it will definitely start to come into play once they sort of get back to the mid 4% rates.
What do you think, Jim?
Yeah, look, I think an appreciating currency ultimately will reflect in the inflation rate, so that will help to keep rates low over the longer term. But I think, you know, I do think that that this task is something that needs to be done quickly. When you're talking about movements from 3.25 to 3.5, 3.75, they're really not material movements, and by the use of larger increments, you can make a significant statement.
Where do you think we're going to end up in terms of the peak in rates in this cycle?
I think we end up at a much lower level than we did last cycle. I think that the NAB results today were sort of very important as well in the sense that bad debts are continuing to deteriorate. There's also comments about the consumer base has so far been strong, but I think the consumer has barely delevered throughout this recent cycle, and I think they'll start to feel rates much sooner than they did last cycle.
Yeah, there's a very high level of leverage, isn't there, amongst consumers? A lot of people have really suffered. Their net worth has really taken a hammering during this bad economic downturn, haven't they?
Yeah, they have, and obviously that's something that will be visible in the data as we move through this.
Let's get back to our guests right now. Gentlemen, thanks for staying with us. Jim, this time let me start with you. How do you incorporate your outlook for Australian interest rates into your investment strategy?
Yeah, well, I think rising interest rates almost counterintuitively are a really good opportunity to lock in longer dated returns. So we're sort of looking for, as rates rise, looking for opportunities out on the curve. So as, say, the longer-term fixed rates, say the 5-year swap rate moves up towards 6.25, 6.5, we think that's a very attractive sort of base level, if in fact it gets there, to be pushing money out along the curve. So yeah, look, it's a timing thing. I think it's something that you can implement over coming quarters. It's not something you need to rush to do, but you do need to it does need to be timed with the tightening cycle.
Yeah, absolutely. Timing is everything, isn't it, in this market? Rob, would you agree with that, or would you say the better opportunities lie overseas?
I'd largely agree with that. I think there are some very attractive opportunities in US and UK rates as well. But if you think about the CPI printing in the sort of 1.5% range, and maybe eventually going back into the low 2%, to be earning 6.5% as a nominal rate and locking in sort of 4% real wealth creation every year, it's very attractive. And I think Australian investor base is somewhat spoilt versus the global comparisons that are in some cases earning negative real yields across their whole bond markets.
We've got a lot of yield out here in Australia. If we can just pin it down to, say, 3 top investment plays in fixed income right now, can you name them? 1, 2, 3?
Well, I think, there's a really boring one that everyone seems to be ignoring, and it's really interesting because, if you look at a simple product like a term deposit, even where we are now in the tightening cycle, you look at, say, a 2-3 year term deposits, up to $1 million, they're government guaranteed, you can achieve yields of 6.75%, 7%. Now, that'll probably see you through the cycle in terms of looking at other things, and particularly when you overlay the risk involved with that. So, we can't see anything wrong with those types of opportunities, even though they are pretty dull and boring. But we also think that it's worthwhile allocating to inflation-linked securities, and if people can do the proper analysis, some of the corporate issues.
Really quickly, Rob, 10 seconds.
Yeah, just one thing, with the RBA definitely in play, I think the Aussie dollar continues to be quite well supported in the 90 area and above.
Thank you so much for joining us, to both of you. Jim Stening from FIIG Securities and Robert Mead from